It's time to talk about variable rate mortgages because they're back and they should be included in the conversation that you're having with your broker. For the first time in a few months last week, we saw fixed rates rise, but inflation data came out and we're still expecting variable rates to drop. This is great news for people in variable rate mortgages. And this is why you need to know more about them. For the most part, there's two types of a variable rate mortgage. There's an adjustable rate mortgage and a variable rate. The variable rate mortgage, your interest rate is floating, but your payment is not. It's fixed. This means that any change in your interest rate will impact your amortization, not your payment. If interest rates drop, you're going to pay off your mortgage sooner because you're making higher payments towards the principal. Conversely, if interest rates rise, your amortization is going to get stretched out past the original amortization. There's pros and cons to this, but it depends on your needs. The second type is an adjustable rate mortgage. For an adjustable rate, as the interest rate changes up and down, your payment changes up and down. This ensures that you're always paying the same amount of principal on every payment and your amortization can stay the same. So if you can afford some changes in your monthly payment and want to be secure about when your mortgage is going to get paid off, the adjustable rate could be right for you. One of the most overlooked aspects of a variable or adjustable rate mortgage is how the prepayment penalty is calculated. You may hear horror stories of people breaking their mortgages early and having to pay a huge payout penalty to the bank. More likely than not, the cause of that penalty is an IRD, an interest rate differential penalty. For the most part, these don't apply to variable rate mortgages. The penalty that you will pay is 3 months interest, which is usually significantly less than an IRD penalty. For the record, on a fixed rate mortgage, you'll pay the higher of the IRD penalty or the 3 months interest. It gets even more convoluted. Some lenders calculate that 3 months interest at prime, whereas other lenders calculate it at the contract rate. Why does this matter? Because the contract rate is usually less than prime. Whenever we're looking at a line of credit or something like that, it's prime plus. However, on a mortgage, you're usually getting a discount, prime minus 0.8, prime minus 1. So you could be saving a full % of interest on that payout penalty. With rates dropping, the ability to still have a fixed payment on a variable rate mortgage, and the spread between fixed and variable starting to thin out, it could be time to start thinking about a variable rate mortgage. If you got questions, you know who to ask.